Hello and welcome to another of our market broadcasts. Now, today we actually have something of a special episode, which is themed entirely on the topic of gold. And we're talking about gold in this broadcast simply because it's been it's just been an incredibly interesting story that's unfolded in the precious metal space during this Wu-Flu crisis. So on today's call, we have got Nickolai Hubble. We also have Eoin Treacy, who is ringing in from LA. Gentlemen, thank you very much for joining me. Just to start off with, I was thinking, could you both share your thoughts on how gold has performed, and silver, if you like, during this period? If you were surprised by its behavior or if you were disappointed. Eoin, start us off, will you?
Well, I think we had the big decline in March, which really challenged a lot of people's conviction. But then we had the equally impressive rebound in April. And you got to think about what happens in any kind of crisis. It's contagion selling. Everything goes down together. It's the things that are generally going to lead us up and away from the crisis tend to bounce first. And that's what happened with gold. So the very fact that it was at a new high in US dollars in April relative to the peak that it was in March was a clear confirmation that this is a story that is likely to not only benefit from the wider scenario, but is also something that is a much bigger story in its own right.
Nickolai, what have you made of gold's performance since March?
Yeah, I think it's a textbook example of what you'd expect. You've got the initial sell-off because of gold's ability to raise cash for sellers. It's very liquid, both in the futures markets, obviously, and also physical. And then you've got the early rebound as the central bankers and the governments come in with their various stimulus efforts. But what's bugging me lately is that the rally has stalled. So around about the end of March and the beginning of May, we had this wedge formation shaping up. And a lot of gold analysts were promising the moon based on that wedge, saying that when the gold price did break out of this wedge formation, it would soar. And that was true for a few days. But since then, it looks like the gold price has been going effectively nowhere. It's been going sideways around about the 1,700 US dollar mark. And what I'm really curious about now is, well, first of all, why has that happened and which way gold goes from here?
Right, Nickolai, just before we continue, could you clarify for some of our listeners who are maybe not big into the whole charting world, what exactly a wedge is? And I assume it was the gold price in dollars you were looking at and why that is important.
That's right. So wedge formation is when the price of gold is fluctuating up and down, but it's doing so in a narrower and narrower band over time. And historically speaking, that suggests that when the gold price does break out of that wedge, so when it breaks the line that makes it up the top of the wedge or the bottom of the wedge, that breakout will signal a large move thereafter. And initially that did happen, but it didn't happen for long. And since then, we've been going nowhere.
So in terms of where we go next, I suppose, with the gold price, I guess we should probably dwell on what really moves the gold price. So we're looking at that wedge. You're feeling rather befuddled as to why exactly it has happened, why gold has moved in the way that it has. Well, what really does drive the gold price? Eoin, what do you think? Because we've had quite a few discussions on this, and I think we're mostly on the same page with what is the fundamental driver of gold price, which is on the topic of real interest rates, correct?
So it's negative real interest rates are the thing that creates bull markets in gold. But that's often something that people have difficulty really getting their head around. So maybe it's easier to think about it as gold does best when it is appreciating in most currencies. So therefore, it's when people are worried about the value or the ability of the money in their pockets holding value that they then turn to gold. And I think that is why we have had this hiatus over the last 2 months. Now, I think there are two big reasons. The first is if you go all the way back and look at where the peak was in 2011, everyone will tell you it was at 1900. But the reality is that gold only traded above the $1,800 area for about 3 months. And then between the end of 2011 and the end of 2012, it went up to test $1,800 3 times. And then it declined in a big way. Well, the price today is at 1,724. And when we look at where the peak value was just about 4 or 5 weeks ago, it was at 1,760 odd. Now that's just below $1,800. To me, at least, this looks like nothing more than a consolidation in the region of a previous area of resistance. It's a big psychological level to look at the $1,800 handle and think, well, do I really want to be the first person to buy at that handle when I know what happened back in 2011 and 12? So we could be in for some additional ranging. But then that brings us back to the other point, which is about the value of the money in your pocket. Because what we've seen is approximately $10 trillion has been dumped into the global financial markets in the space of 3 months. And that is creating the conditions for competitive currency devaluation. So it's now looking like the dollar has probably peaked. The USA is responsible for about half or maybe more than half of all the assistance provided by central banks and governments. So that represents a headwind for the dollar. It also then represents a tailwind for other currencies against it. And that has sapped some of the short-term demand for gold. Medium term, all those other governments are also going to have to create massive monetary and fiscal assistance. So eventually then gold will be the only one of the major monetary instruments that cannot simply be lent into existence.
Right. It does feel like with the huge amount of stimulus that is arriving and will likely continue considering the economic outlook as it stands, that gold should be it's hard to make a massive argument against gold, even though it has had a very good time by some measures, considering how much time has passed since since the beginning of the year, I suppose. Nickolai, in terms of why you felt somewhat confused, or not confused, but puzzled by the action of gold, do you think is that answer that Eoin's given, does that satisfy you?
Yeah, it's a big part in explaining it. I guess I'm disappointed then that gold isn't looking far enough ahead. And it's exactly the argument that Eoin made is, there's no central bank of gold printing gold. There are central banks of every other currency printing every other currency. And yet, the gold price hasn't reacted in the way that you would expect, given those facts. So maybe it'll just be a matter of time before it catches up. But if we can return to this idea of negative real interest rates driving the gold price, if that is the driver, we should be thinking about what will happen to inflation and interest rates over the next few months.
Yeah, it's a good way to put it. Though I guess if you combine both of those, I mean, you're just talking about real interest rates, right? So you did inflation. If you just take the nominal interest rate and then you subtract the amount of inflation from it, then you get the real interest rate. And so it's when that rate is negative, as Eoin described earlier, that is such a tailwind for gold, because it's as though the value of currency is genuinely simply being burnt. There's nowhere that it could be placed that would actually protect its purchasing power. But I guess on that, with inflation and with rates, so we now have central banks doing an awful lot to try and prevent interest rates from rising in a major way. So we now have Jerome Powell at the Fed not only buying bond ETFs as part of the portfolio of tools that the Federal Reserve can print money to use. But they now there's the announcement that they will be purchasing a diversified individual corporate bond portfolio. So we'll have the Federal Reserve printing money to lend to companies at very low rates. And so, of course, with rates being pegged at that level, it does feel like if inflation gets much higher than that, then gold is going to do incredibly well. On that note, or on that note of inflation, one thing I think I'd be very interesting to hear the pair of you discuss actually is the subject of whether or not inflation really can arrive in a very big way, or at least whether or not it can arrive very rapidly here in the developed world. So, of course, we're all familiar with the story of Japan, where it had this great boom, and then it was halted just before the beginning of the 1990s. And of course, there's been all of this negative interest rate policy, lots and lots of QE, all manner of different market intervention and money printing from the Bank of Japan. However, we have yet to see strong, continuous inflation coming out of Japan, despite during that period there have been quite strong fiscal government spending initiatives. So, they spent plenty of money building up their own navy, for example. They're getting all manner of very sophisticated submarines on the go these days. And yet, this inflationary force doesn't seem to have exhibited itself in Japan. Now, all things being said, the price of gold in yen has performed fantastically during that period. But just in terms of the inflation as people think of it, so the inflation that we've forgotten about almost in terms of the day-to-day purchases and the like, it doesn't seem to have arrived there. And I'd like to know if both of you think that this is something unique to Japan that wouldn't happen here if we did the same things. If governments began spending vast quantities of currency on all manner of spending initiatives, or whether or not what happened in Japan might happen here as well, and you might simply have lots and lots of government spending initiatives which cause small spikes in inflation, and then it sort of returns to this deflationary narrative. Now, I know I've said quite a lot there, but Eoin, what do you make of that? What's your read on the situation?
I think one of the reasons why Japan did have the lost decades and lengthy periods of deflation was because even though interest rates were very low at home, they were very high everywhere else. So there was the clear ability to take some of the money that was created at home and invest it overseas for higher yields, and and that created the short or the yen carry trade, the proverbial Mrs. Watanabe buying New Zealand government bonds at 8% and bringing the proceeds home. So that ability to go somewhere else to pick up a better yield was something that prolonged the deflationary spiral in Japan, because it doesn't matter how much money they were printing, none of it was staying inside the economy to stoke economic activity. We have definitely seen something like a Japanification of Europe, where there has been prolonged deflation, very low interest rates for a decade already, little in the way of any evidence that the situation is going to change anytime soon. So that's certainly the case. Now we've also seen in the Anglosphere where interest rates have come down precipitously. So that's limiting the range of possibilities where an investor, like a pension fund or a life insurance company, can go around the world and find that better return. Therefore, the potential for the long deflation is less. I think the correlations that we have in 2020 with 1968 are very strong, where we had student protests. Then we had Martin Luther King was assassinated. Robert Kennedy was assassinated. There was the Vietnam War, which was incredibly unpopular. Now, we can then contrast the COVID-19 lockdowns, the massive student debts, the inequality that we have in various parts of society, the big imbalance in concentration of wealth between the older generations and the younger generations, and then the parlous state of government finances before this crisis. The answer back in 1970 was for the government to spend as much as was required, and that the central banks would just print the money that they needed. It was called debt monetization, debt financialization. That's exactly what modern monetary theory is. Now, everybody knows that inflation peaked in 1979 and 1980, and the new bull market started. But the 1970s were really difficult. And inflation was kicked off with those student protests in the late 1960s. The actions of governments to try and deal with those protests sowed the seeds for inflation. And then there was a massive inflationary spiral from the middle of the 1970s through to the early 1980s. And I think that is what our future is, that we are now going to see, we've already seen massive spending in response to social unrest. And in a democracy, democracies survive by giving the people what they want. And what people want is more money. And that's what they're going to get. But the value of that money is going to degrade against real assets. And property is one which is already expensive. Gold is another which is not nearly as expensive, and therefore it has much further room to appreciate.
Nickolai, what do you make of the Japanification narrative, and also if you have any comments on that idea that social unrest, just as it did in the 60s, was what led to the grand decade of inflation that we all look back on now?
Yeah, I'd like to add demographics to the story that Eoin told, but I think he's right about Japan being fairly unique with its trade and savings and the carry trade and so on, and the comparative interest rates around the world. And at this time is very different to what Japan experienced. But I think the key thing I would focus on is that in the past, so say the last 15 years, we've had combinations of fiscal stimulus and monetary stimulus, but we haven't had them working in concert in the way that they are now, and will continue to be. So we've had waves of QE, and we've had austerity, or we've had big fiscal stimulus, but the Federal Reserve didn't act until those stimulus packages were passed. So I think we were missing one half of the equation required for inflation to break out. Each time you would have expected it to break out based on the fiscal stimulus or the monetary stimulus in the past. And now I'm expecting inflation to break out based on the fact that we are getting both of those parts of the equation, both the fiscal side and the monetary side in unison. And we've gotten rid of this taboo of using those in unison. And it's all just a matter of willingness to bear inflation from this point on. There's no longer any other constraint on the central bankers and the politicians acting together. And modern monetary theory is just the fad sort of signal of that. If it wasn't MMT, they'd find something else to explain why money printing was wonderful. I don't think their theory is the thing to focus on. I think it's the fact that it's now part of the Overton window, as the popular language today goes.
Just to dwell a little more on the Japan side before we go forward, as I do think it is quite a sort of an important example for people to pay attention to, with how far along the road that they've gone with their central bank intervention. I mean, I'm under the impression that Japan's great spending booms did actually take place during some of these quantitative easing, some of this, central bank expansion. So, I mean, are there not examples of both monetary policy and fiscal policy working in concert in Japan?
Yeah, there definitely are. The differences being that those efforts were absorbed elsewhere in the ways that Eoin was explaining with the carry trades and the savings and the trade balance issues. Right. And I think there are a lot of other ways in which Japan is odd, but the most important one being the fact that it was only Japan at the time. It wasn't the Japan and the rest of the world.
Right. Yeah. On the topic of gold, then we move to the sort of gold mining stock space. So you would imagine, and plenty of people have imagined, that with such a scenario ahead of us, as you've both so eloquently described, that the gold mining space, these companies which have all of this gold beneath the ground just waiting for them to dig it up, would have done pretty well. And considering some of the writing has been on the wall for this for quite some time, that the gold mining space would absorb a lot of capital, and it certainly absorbed a lot of capital. It's also been accused of destroying a lot of capital in terms of how it's been spent and how it's been moved around. Since 2011, it's been an absolutely brutal time during some of those years to be a gold mining investor. Though in more recent years, of course, it has picked up a bit, and that's what Eoin, you do at Gold Stock Fortunes, and which we all observe, and it's a fascinating subject. But in terms of the gold mining space looking forward, one thing I find very interesting that I was wondering if you could both sort of comment on is the fact that with interest rates, as we've been talking about, being suppressed all the way around the world, with low growth leading to sort of a low dividend environment as well, do you not think that gold miners might be something that pension funds and all of these other major investors that really need income would turn to if they're the only ones that are paying high dividends? Because high dividends is something that the gold miners have really started, to start divvying out in just the last 6 months, really. Eoin, could you comment on that?
I think the answer is eventually. But one of the big challenges for institutional investors is the size of the sector, because there's only one gold miner in the S&P 500, and that's Newmont. And there's only really a handful that have got sufficiently large market caps to make any kind of impact on the bottom line of an institutional investor. What we need to see, therefore, in order to encourage that institutional asset class is higher prices, that the actual shares themselves need to be bigger in order to encourage that wall of additional liquidity from the institutional market. But I do believe that is what we're going to see. Generally, what they will then do is they will fund new mining exploration and new building of mines. Now, generally, when that happens, it's something we need to be aware of, because when those new mines open, supply increases, and it's usually something that has a deleterious effect on the price. One of the reasons why gold miners have been doing better is because they're not engaging in massive new spending programs. They have become chastened by that long bear market that you were talking about, and they're not spending their free cash flow. They're accumulating cash flows, and they're boosting dividends. Now, that is the golden period for dividend-hungry smaller retail investors, because they get to buy the miners when they're increasing their dividends and before the prices have gone up. By the time the prices have gone up a lot and gold is a real front-page news story, well, then the bargains will be gone. So this is the time to become interested in the sector, in my view.
Nickolai, what would you say to that in terms of the just some of the very interesting dividend sides to the gold mining industry?
Yeah, I'd point to the fact that the junior gold miners have not performed as well as the big, large gold producers, and that's the giveaway that what Eoin is saying is correct, because this isn't just a matter of the riskiest gold stocks going up as the gold price rises, as you might expect if you weren't of the same opinion that Eoin is, and the reason being that a very risky gold stock, which is in trouble, benefits disproportionately from a higher gold price. But what you've actually got is the opposite. You've got the steady, stable gold producers performing very well, and that is because they're converting that higher gold price into cash flow for investors, which is what investors are chasing in a low yield environment. Right.
In terms of could you expand a bit actually on that difference between if you just look at the ETF side, if you're a gold speculator, you might invest in something like GDX, which is a very large gold mining. It's generally the more senior, larger gold miners. And then there is the junior version of GDX, which is the GDXJ. And there's that very interesting sort of almost dichotomy where with GDX doing well and GDXJ not doing very well. Do you think, because if you were, for example, if you're just sort of the retail investor, the retail punter, you would, if you're more on the speculative side, you might favor something more like GDXJ, simply because the junior miners, there's so much more potential that could be, so much more of a could be factor to their outlook relative to the much larger firms. And considering, so much of the gold sector, it feels to me, so much of the interest comes from the retail side. I find it's almost unique amongst all of the investment sort of share classes that you find, that precious metals resources, not just resources but precious metals, is something that is uniquely loved by the retail investor, or at least by a certain sort of sector of the retail investor. What do you think that difference says? Because I would imagine that the GDXJ ETF getting juiced a lot would be more of a sign that the retail investors are really interested in this. So I guess that difference probably, I guess to me, it sort of argues that Eoin's right in terms of that golden period being here, because the retail demand isn't anything like what it was at, say the previous peaks were in 2011.
Yeah, there's a big following of the smaller cap resource companies in Australia, where I became interested in these types of stocks. There's a real community of people who follow them. And one reason that they are underperforming is that we're in a financial crisis environment, or at least we were. And those stocks, those junior stocks, they rely on being able to refinance themselves as they do some exploration or some development of mines. So you would expect them to underperform, especially early on in a gold cycle. And they're going to struggle with their financing, and that makes them more risky. And I suspect within that junior ETF, there's a couple of companies that have really struggled with the recent crisis and trying to finance during a time that's either verging on a financial crisis or in a financial crisis. And I think gold investors need to realize that if they're betting on gold and gold prices because they're expecting crises, then buying junior gold mining stocks is not a great idea. If they're expecting the gold price to rise as the central banks and the governments try and kick the can down the road, then perhaps those junior gold miners will start to outperform eventually. But for now, at least, you want to stick with the credible larger gold miners that are not going to get into financial strife and that are going to turn the higher gold price into the dividend income. That is, it's the old two birds in the bush, one in the hand story.
Right. Now, we haven't dwelt too much on the price of silver thus far in this broadcast. It is very much worthy of a mention, I believe, and its performance has been pretty interesting, to say the least, following the so far this year. I was, when we first had that big sort of wipeout in the in markets in March, where there was all of this liquidity just sort of sucked out, pretty much everything fell apart from the dollar. You saw silver get really, really badly trashed. And I made a comparison to it with effectively what had gone on sort of 2007, 2008, where you had Bear Stearns and then Lehman. There was a similar sort of suck out of liquidity. And then it was after that point, after everything, after silver had really, really broken down to a really exhausting low, that it then went on to soar over the next several years. And I made the comparison in March that maybe this is the same thing that's going on now, right? Because you saw that a really brutal punch. Eoin, what do you make of silver at the moment, and what do you think of its prospects as we go forward this year?
I kind of regard silver as high beta gold, so it does tend to move more. And it's the kind of people that get really interested in silver are also the kind of people that get interested in junior gold miners. And silver does tend to move more than gold, which is why people want to own it in a bull market. But if we go back and look at the gold-silver ratio and concentrate less on the values and more on the timing of the turning points, relative to what we've seen in gold and silver pricing, what we can actually see is that silver has historically lagged at the beginning of bull markets in gold. But then it tends to play catch up. And it's generally when silver does start to play catch up that interest in the precious metal sector then starts to really ramp up, where much more money starts to come in, where there is a lot more interest in investing in speculative ventures. And realistically, there is nothing more speculative than buying a patch of ground and digging a big hole in it to see if you can find something. So, realistically, you need to be pretty bullish about the environment generally if you're going to do that. So I think the outperformance of the smaller caps and silver are out there in the future, but we're probably not there yet. And I think it probably does come back to the fact that I really do think that we're sowing the seeds today for a future inflation problem. But the urgent risk in the short term is deflation. And as long as that's the case, then that is probably going to sap some of the interest in the precious metal sector, and not least because it's inflating the price of stocks. The really big bull market that started off in 2000 in the precious metal sector was greatly aided by the fact that stock markets were doing badly. Now, that's something that is creating competition for gold in the short term, that stock markets are still really quite firm. If we do start to see much more volatile activity in stock markets, not just on a day-to-day or a week-to-week basis, but on a more prolonged basis, then that is the kind of thing that will change the way that people think about precious metals in a big way.
One thing I'd just sort of like to ask both of your opinion on is on that industrial actual use of gold. So with the gold price going up, as they always say, the cure for high prices is high prices, because people find new ways of bringing supply online, and they'll as a result that should put the cost down. And as you say, we get to the more speculative side where people just start digging in the dirt and seeing if they can find some gold. In terms of the actual sort of demand side for gold, and as you say, people thinking about gold in a different way, and not just gold, silver for that matter as well, and platinum, which has of course been had an incredibly unfortunate few years. In terms of what the actual demand side looks like, I mean, do you guys see any different uses for gold, or on the more industrial side, of course, we've got something of a new space race on the go. And I remember my mum when I was a kid telling me how astronauts' visors are sprayed with gold to prevent them from going blind from the sun's rays. And there's of course satellites use an awful lot of gold. But I mean, are there going to be any new industrial sort of sides to gold, like through a space race, that would actually have any meaningful impact on the gold market as a whole?
I wouldn't be relying on industrial uses for gold to argue about gold prices going up. The primary reason to own gold is because people like to buy it and then lock it away, and for it to never see the light of day again. And I think that's the primary reason that people should invest in gold, because when we think about just how much money is being printed and the debts that represents, the clear intention of central bankers and governments to treat the coronavirus as a natural disaster, and simply to think that this is like a hurricane that instead of lasting for 4 days is probably going to last for a year, and that whatever money needs to be spent should be spent, and that is probably the right thing to do. It doesn't mean that we don't have to pay the money back, or that some of that money is going to create inflationary pressures. And when we start to think about those factors, then gold ticks a lot of boxes.
Right. Nickolai, have you any comments on the industrial side of gold? Because I know it's something that you've been looking at a fair amount in recent weeks.
Yeah, I've got some personal experience with it with a firm that my dad is an owner of a small firm, and they use gold to plate the audio equipment for extremely high quality audio recordings. But even that is a very small amount of gold on each one. And I think Owen's right. I think so. The way that I would explain this is that if the industrial demand case for gold exploded, there is so much gold locked away for the purposes that Owen described very well, that it's a store of wealth, that gold could just come into play for the industrial use, and that excess supply would just dominate the industrial use story. So gold is unlike any other metal in that sense. There is this vast amount of gold in storage to preserve wealth that can be brought in for industrial use. And that's that doesn't exist for other metals in the same way. They don't have this huge stockpile sitting there ready to be used if the industrial story actually appeared in a convincing way. So I don't expect that to play a huge role either. But what I would look at and encourage gold investors to look at is that a gold rally is unlikely to be sustainable unless the silver price keeps up. In other words, if gold does spike and silver doesn't, that is the signal that something odd is going on in the gold price. And eventually that silver price does have to catch up if our story about inflation is correct.
Right, and I think probably we have gone on for a while, but one of the topics I think we should dwell on that inflationary side is, well, just broadly the commodity space as a whole has been it's been one of those sectors which everyone thinks it's hit a bottom and then it just manages to break lower again. Just if you look at soft commodities, look at even at hard commodities, just if you take that the Goldman Sachs Commodity Index. Something that's very popular. I believe it's the fellows at Incrementum who published the In Gold We Trust report, who were one of the people who first pointed it out as the ratio of those commodities relative to the US stock market, so the Dow Jones. Just that ratio between the value of real hard stuff we pull out the ground and the value of shares on the stock market, they're generally not, well, at the moment, they are hugely out of sync with one another, and there have been a few times in history where there's been a bottom, and suddenly commodities start outperforming stocks, or they start gaining value relative to stocks, and a lot of people wonder, including ourselves here at Southbank, very much whether or not now is the time. And with inflation being this narrative, inflation arriving, as you say, from debt monetization. And all these fiscal spending plans, it does sort of beg the question: is now the time when we're finally going to see? It's better to bet on commodities than it is on stocks. Now, Owen, what do you make of that?
I like those long-term comparisons. And I think the chart you're talking about from Incrementum goes back to well into the 1800s. But the problem with that, using that as a timing tool, is that when you look at 200 years of history and talking about what prices are going to do from one day to the next, you get a bit of a mismatch.
Right.
So I think what it does tell us is that we're in the right area, that that this is the time to start thinking about these topics. That when you get these ratios at extraordinary historic extremes, then you're in the right wheelhouse to be thinking about what happens when this thing does turn around. So yes, I think that commodities are very low, and when everything else is very high, it is the right time to start thinking about them, because sooner or later you're going to have people that are going to start thinking about using cheap commodities to do stuff. That's in fact economics 101. When the value of an economically useful resource drops, demand increases. And the one thing we do know is that every government has talked about new infrastructure. And India wants to compete against China. And they have got 600 or 700 billion people under the age of 25. They need roads and ports and airports and power plants. Our dams, roads, power plants have been around for 50, 60 years, and they need replenishing. President Trump said, I think it was just yesterday, that they're going to spend $1 trillion on infrastructure projects. Well, you can't build infrastructure without commodities.
And I think that's what connects all of this together, is that if we are about to experience this inflationary period caused by monetary and fiscal stimulus, and commodity prices are bottoming out relative to stocks, well, that fiscal stimulus is going to be put into infrastructure, which brings in that demand for commodities. And that's also where you get the inflation, is that those rising commodity prices as the infrastructure kicks off. If you look at that chart from incrementum of the Dow to commodities ratio, the bottoms were during the Great Depression, just before the 70s inflation, and in 2000. So we're at a situation where you would expect inflation and a commodity boom to break out together. And the only way I can explain that is with a huge fiscal stimulus effort.
Now, I think we've almost used up all of our time for today, gents. But Eoin, do you have any closing comments that you would give to our listeners?
Well, I think the most important one is to retain some long-term perspective, because gold does whip around a lot. I think one of the biggest challenges for people is that these instruments are much more volatile than what they might be accustomed to. But that doesn't mean that they're not going to perform when the conditions for everything, or at least everything that we expect to happen, does happen. They will perform. But there's nobody is believing that it's going to happen in a straight line.
Right. Nickolai, any closing comments from you?
Yeah, I just think it's the optimal time to be a commodities and gold investor based on many of the things we've spoken about. And I think that traditionally speaking, gold and other commodities are underrepresented in most people's accounts, in their portfolios, I mean. So, now's the time to make a move.
Very good. And that concludes today's market broadcast. It's been quite a sort of special, unique gold one. Hopefully we'll be able to do some more of these in the near future. But that's all for today. We shall be back again with more market broadcasts on Monday next week. But that's all for the moment. I hope you have a good weekend, and we shall be back with you next time.